Well, we completed another week of steady grinding higher, and it's looking good so far. Like we just had our first red day since last last week, I think. We're not getting many red days, so things are looking very bullish. Bitcoin is really where I think most of the attention has been lately, at least for us. We broke out to new all-time highs for what is it? Third time?
Couple hours. Yeah, third time, but for a couple hours and then
Yeah.
back to mid vamp. Yeah.
Yeah, I'm not too sure what's really causing this, why there's so much struggle breaking out to new highs. Normally, Bitcoin, when it breaks out to new highs, it just goes, but this time it's a little different. It's definitely having some trouble here. But at the end of the day, we're still above mid vamp. Today, it's been holding mid vamp pretty well. So the trend is bullish above mid vamp. I think this is just going to continue to grind higher.
Yeah, I agree with you there. I mean, this is the regime, right? Risk on, where we are right now, that you want to stay locked into your trades. You don't want to be position swapping, scaling constantly, and basically over trading your assets or your happen is in risk on typically moves snap and they run and you don't have the ability to re-enter, right? So a good example is like when Bitcoin really runs and you sell out maybe because it goes up 10% in a week, and then by the end of the month it's up another 20%, and you're like, oh God, I'm now out, I'm off sides, I need to buy back in, and then you end up never getting back in because the position runs away from you. So this is a typical setup in risk on where you see price do a lot of nothing and then a lot of everything very quickly. Specifically, it's very pronounced in Bitcoin. I mean, we've seen that happen last year, right? Going into the end of the year, risk on, you kind of had this choppiness, and then risk on came around and this just ripped. So, what you want to be prepared for is that type of situation where, as long as you're above mid vamp, the base case is we're holding out today. So, the base case here is very simple: all time highs. As long as you're in a bullish trend, you're in a risk on regime, the base case is going to be all time highs. And it's something so simple that even we like to sometimes overcomplicate it, right? In terms of like, oh, are we going to crack all time highs or not? Or is it a fake out? It's struggling. It should be going. Yes, it should break out and it should go. But as long as we're over mid vamp, the consolidation continues and there's really not too much to worry about. Now, we do have retail sales tomorrow morning. As you guys are probably listening to this after the recording, you'll have retail sales today, Friday, and you're going to see how risk assets react towards that. Now, we've been seeing a pretty consistent positive figure on the economic surprise index. So what this is telling me, and this went positive in July and pretty much has stayed there ever since. So by default, look, you're in risk on, right? So by default, good things happen in risk on, and the bad things are written off as exemptions, typically in risk ons. For example, a good circle back here would be to go back to the last NFP print, right? That was bad, but the market ate it up and basically chugged through it. It was a bad NFP print, but the market was able to get over it. So if we look at where we are right now with the economic surprise index, generally everything's been weighted to the positive surprise. So will retail sales beat or miss or outperform? I don't know, right? I would tell you that most likely I would lean towards there being some positive surprise from it. Now, if there is a negative surprise, we're in risk on. I expect the market to probably, as just like the NFP report, eat it up, eat through it, and chug along afterwards back in the bullish trend that we've been seeing in risk assets.
Yeah, I mean, it's so far it's still clear skies. It's really I'm as bullish as you can get, really. I do want to touch on something that we've actually been talking about the last few days, and it's about the September rate cut. So we're almost at 100% chance of a rate cut at the next Fed meeting, but we don't really think that might be the case. Obviously, like odds are it's going to happen, but we kind of think that that might be a policy mistake. And there is a play there if you do want to kind of have like a Hail Mary trade. We've already taken a trade on the SOFR, and I, how about you run us through what you're thinking on why you don't think we're gonna get a cut next meeting?
Okay, so to summarize what you just said, and then I'll add to it, there's going to be a ledger post coming out in the next like 12 or 14 hours after this podcast is recorded live that will encapsulate everything that we're talking about here in more depth and explain the trade for members. So I'm not going to go into the exact trade specifics for members, but we'll touch on the fact that right now there is a trade here. It's not part of RQF, it's more discretionary based. So if you're very systematic and you really don't want to touch the trade, it's not included in our portfolio historical performance or future performance. It's not monitored like that. It's just a discretionary trade we see that has positive positive EV based on what the market's expecting and what we're expecting. And I'm going to go into some of the details as to what we are expecting versus what the market is. So as you can see, the market's pretty much near certain that there's going to be around 90 to 100% chance that there's going to be a rate cut at the September meeting. So let's lay that out there. And then let's also lay out the events that we have coming up. In a week or so, we're going to have the Jackson Hole press conference where Powell is going to have the ability, not necessarily the obligation to do anything towards policy, right? He doesn't have to get update or shift forward guidance, but it tends to happen at Jackson Hole where he can make some sort of semi-stance, right? It's always indirect. He's never going to say, oh, we're going to cut or we're not going to cut. It's more of like a beat around the bush and take what you can from it type of event. And that's coming up. We have another jobs report and another inflation report. Obviously, we'll have PCE at the end of the month as well, right? Before we're going to get the next Fed meeting. So there is a window here where you have to ask yourself, look, is the Fed going to cut 50 basis points? No, I don't think that's even I think if that happens, that's way left tail, right? So I don't think the 50 basis points is an option here. I think it's going to be 25 or 0. The Fed's not going to just come out of the gate at 50. At least based on what we're seeing today. So, okay, now you have the binary outcome of 0 or 25, right? Either they're going to hold or they're going to cut 25 basis points. And right now, 25 basis points is pretty much as certainly priced as you can get. So what could possibly happen here? What could possibly change? Well, today we just got that hot PPI report, which did bring the odds down 4 or 5 points from where they were yesterday. So we were at like 95 yesterday, and I think we closed at roughly 90% of something like that, right? So that alone moved the market a little bit in terms of expectations. But you have to ask yourself, look, disinflation is obviously showing some signs that it's stalling out, and it's actually, you're seeing some sort of reinflationary effects coming into the market. I mean, if you look at our inflation index, right? We've been talking about this reinflation risk for months now. I mean, we've been saying, look, inflation rising, it's bullish for risk assets regardless, right? So inflation rising is a bullish catalyst. Given growth is positive too, and you can see that here, right? Growth index positive, bullish trend. When both these are bullish, it's your best risk environment. You want to be long risk assets, which we have been. Now, the situation evolves a bit from here, right? Because just because the inflation index is positive doesn't necessarily mean inflation is going to run away from you. It just means that impulses are very strong. And we did see some of those impulses die off, but we're still bullish and we could rebound and whatever, chug higher. So the risk here is that the Fed is almost facing the market's pricing in a situation where the Fed is going to ease policy into an environment that inflation likely could see some period of reacceleration. Granted, look, it's going to probably be transitory, right? Like inflation is primarily going to be affected by tariffs hereafter. The deadlines have passed and tariffs are now pretty much, the can has been kicked only so many times down the road. The extensions are there, but the tariff rates are still higher. So the tariffs are going to start bleeding into the inflation reports. And the Fed knows this, right? We all know that at some point, tariff impacts are going to come, but they'll pass. Now, the problem here isn't necessarily the tariffs, because you can write those off as transitory, right? The problem here is you're seeing sectors like services inflation bottoming out. And this is where, everyone was claiming, like, look, if service disinflation continues, you're going to, and I'll pull that chart up right now. If service disinflation continues, then you're not going to really have an issue with with inflation. So like you can look at core services right here, right? So core services stopped going down, ironically enough, right around Liberation Day, and it's been rising every month. The contributions to CPI have been rising. So core services is on the rebound, right? Obviously, core goods has been ripping since Liberation Day, but this is again more tariff related. So now you have two positive rebounding sectors in inflation, and they're the most important sectors for you to have to really bring down headline inflation. So if those sectors are on the rebound, then you have to ask yourself, okay, well, if inflation is bouncing a little bit, what about jobs? Jobs were so weak. We just had that super weak NFP report with those mega revisions. There has to be some reason there. And more on this in the ledger note, which will come out again, and you'll be able to read it in depth. But ultimately, this comes down to immigration policies, taking supply out of the workforce. What you're doing, right? You're essentially lowering, and I'll pull up the labor chart here just so we can take a quick look. What you're essentially doing is, if we look at the blue bars, which are the corrected values, right? When you have extremely high immigration, and then you basically create this surplus of supply that increases the amount of non-farm payrolls required in theory, right, to be absorbed to prevent unemployment from rising. When you do the opposite, you almost suppress the unemployment rate. So what happens here is basically when you have mass deportation and mass removal from the workforce, you're lowering the supply, which in turn weighs down on the unemployment rate. So one could even make the argument that if the immigration policies weren't enacted, maybe the unemployment rate would be higher than where it is today. Now there's a push and pull, right? Because the jobs report that you're seeing is also influenced in some manner, indirectly or directly, from immigration policy changes. So they kind of go hand in hand, but they're not directly related. So you have to look at this as a whole picture and keep it very simple. The immigration policies are going to dampen the required payroll numbers that need to come in every month to keep the economy above water. So you can get a 50, 70, 80,000 NFP print, whereas a year ago that was very weak and that's problematic. But here it may be more imbalanced and it might not actually be an issue. Okay, so if that's going on, and labor was more of, as the market probably picked up, a more of a short-term, surprise shock scare than a real systemic or labor shortage issue in the economy. If the market thought otherwise, it would have kept selling. Then you have to go back to that inflation thesis we were just talking about. Well, if labor's actually in balance and there's not a significant fear of deterioration, well, where's the Fed's reason to cut? Because most would argue, look, unemployment, labor, etc., right? Poor revisions. This print has the ability to be negative, and then you have the seasonality effects. Like last year, we had this dive and the reacceleration into the summer end. So there's a lot of things that the Fed could lean on here and say, let's wait and see. We might want to just wait another NFP print. You'll get two. Maybe they want to wait till, I think it's October, right? And the meeting after that, where they can. It might be November. Let's see. I believe it is. Let's see here. No, it's literally the end of October. So there you go. The end of October to see if you get that extra and the extra payrolls print, and you can see, okay, is it problematic or not? Now, that's where I'm thinking. I'm looking at this and saying, okay, well, there's a lot of like push and pull on the board here. The labor market isn't in shambles. At least not yet. Inflation looks like it's actually rebounding a bit, and it's still well above target. So the Fed can't say disinflation is, coming into better balance, or inflation is coming into better balance for rate cuts. It's really, if anything, the opposite's happening. And the unemployment situation is, I don't think, as severe as the market made it out to be last week, which is why we've rebounded in equity. So I kind of see this little bit, this little asymmetrical play here, where maybe the odds are 25% of a cut or 40% of a cut, but I don't think 100% of a cut is right.
Yeah, now, I mean, if you compare to the Fed's economic projections as well, like we are pretty much doing the opposite of what they were expecting was going to happen this year.
That's funny enough you bring that up. Yeah. So like, look, the median unemployment rate, right? The median unemployment rate for 2025 is 4.5%. In better terms, the range is 4.3 to 4.6. The unemployment rate, let's see, the unemployment rate right now is 4.2%.
And we've got
So
4 months left
we
in the
got
year.
you have 4 months left in the year. So what are the odds the median's going to get to 4.5%? Right? Okay. Pretty low. I guess it's very obvious it's very low. And let's look at PCE, right? So let's see. I think we can pull up PCE annual, right? Let's see. Yeah. Okay. PCE is 2.6%. The Fed actually is looking for a 3% median this year, right? So we are at 2.6%. Now, granted, how this print probably rises, right? So it looks like inflation is actually rising towards their median faster than unemployment. And very much so with all of this, right? You're looking at a 3.9 median Fed funds rate, or ultimately, you have the range that's inclusive of one hike and some more cuts. But ultimately, you're talking about one to two rate cuts the Fed is expecting in the rest of the year. So, what does this mean now? What is this telling us? Well, it's telling us that the unemployment rate is far off of where it would be, where the Fed is. So the Fed is expecting an unemployment rate of 4.5% and PCE of 3% to bring the rates down to roughly 3.9%. This is very layman and vanilla out, but that's what you need to pay attention to. So if unemployment is at 4.3, 4.2, right? And PCE is at 2.6. Well, you kind of have the complete opposite going on here. Unemployment's below their estimate, and so is inflation, right? So why are they going to be more aggressive with cuts? It makes absolutely no sense, right? So they are looking at roughly 2 cuts, letting unemployment drift up to 4.5 and letting inflation drift up. You're not even seeing that. So it makes me think like the Fed internally, based on these prior estimates, are a bit more hawkish, at least on the estimate side of the last SCP meeting, which was in June. So we're going to get another one of these in the September meeting. Ultimately, I think that you look at this and you say, okay, the Fed, obviously their projections aren't matching what, you have people like Waller dissenting, you have Fed speak somewhat dovish. It was a bit more dovish up until this morning when the PPI report came out. Then some headlines came out about inflation uncertainty, obviously, given the PPI print. Now, the Fed doesn't explicitly track PPI, but it does, in a way, feed into PCE. So the Fed's obviously watching this, and the worst thing they can do is they can cut interest rates here preemptively on the idea that the labor market has the illusion of being weak, but it isn't. And what that's going to do is essentially line them up for a policy mistake where maybe we see a persistent trend in inflation or in reinflation, where inflation starts accelerating up. And the Fed's at a point where remember, the first time they cut, they're going to move forward guidance as soon as that happens, right? As soon as they start cutting and they kind of, unless they really preface it with the idea that they're going to pause right after it, there's going to be a forward guidance implication to that. So within the scope of what's going on here, the Fed likely cuts based off what the market's saying, but I would deem it a policy mistake, which likely leads me to believe that 100% probability of it happening based on specifically the last NFP print, which rose odds from I think it was 40 or 50% to 100. So literally odds doubled from that NFP print, which got shaken off by the market. It makes me think that just maybe the market's either mispriced or the Fed will actually enact a policy mistake. Now, to bring this back to our positioning, right? There's a SOFR trade that can be taken here with, I would think, asymmetrical payoff, given if the Fed holds or if they cut. And then one step further to our actual models and what we track publicly and what we run our significant amount of our own money in, RQF. This is actually very little implication if the Fed makes a policy mistake or they don't. I don't think it's going to matter to the NASDAQ if the Fed makes a policy mistake here. Simply put, what you've been seeing happen here on the board this past 2 years, 16 to 24 months, is ultimately you've been moving cuts around the board. And a good way to look at this is the terminal rate. So if we go back 24 months here, what you'll see is that all you've done is you've pushed and pulled the floor in a 1 or 1.5 point range. But what we've been seeing the last 6 months here is the floor is almost steady, but you're just pushing cuts out. You're shuffling cuts across the board. And that doesn't really matter too much. What concerns me for risk assets is watching the floor fall apart like it did last July, where it really just fell into the summer, through the summer. And it was falling at a pace that the market started fearing a recession. Risk assets started selling off, bonds were ripping, and that was the recessionary indication in the market that things were going south. We're not seeing that at the moment. A gradual chop and grind lower is not that risk. You want to see the terminal floor fall apart, and we're not seeing that. So all these semantics of, is the Fed going to cut it or are they not going to cut? It's irrelevant. Because at the end of the day, the market is still expecting a floor of about 3% on rates, which what that basically means is over the span of 10 years, your 10-year bond isn't going to move too much. Rates aren't going to actually move or unhinge up or down if the floor is steady. The only thing that's going to move rates is essentially the expectation that if the Fed is making a policy mistake, and that can only go so far before the floor starts moving and the market starts correcting for the Fed, right? And basically bond yields blowing out, right? If the bond market thinks the Fed's making a policy mistake, you'll hear it right away, right? Every time Trump tries to float headlines of firing Powell, the 30 years is ripping. Yield is ripping because the market does not like that issue of a potential loss of Fed independence. And to hone this all back into what we were talking about earlier, it basically looks like the market doesn't care too much about a lot of things, which it's just another confirmation that, look, you're in risk on. The market's going to do what the market's going to do, but when it's shrugging off a quarter million head revision on NFP, it's seeing past it. It's looking at something else, which makes me think that, what ripped when the market dipped, what ripped were the odds of a rate cut in September when the market dipped. And rate cuts are at, now, like I said, 100% for September, roughly, in that 90 to 100% range. I can tell you this. The reason the market rebounded was not because they added a rate cut or they moved the rate cut, right? Because they didn't add a rate cut because the floor is the same. There's no new rate cut here. So what happened was they pulled a rate cut forward. So the market isn't like, oh, gee, okay, we pulled a rate cut forward, we're safe. That's not what happened here. I think the market looked past it. It's not too concerned. And the market is saying, look, the NFP report is probably bad enough to spook the Fed, but not really tank stocks. And that's why I think that you're seeing those types of odds being priced into the SOFR curve or the policy curve, but you're not necessarily seeing the risks associated with weak labor. Even look at bonds, right? Just let's take a quick peek at bonds. Bonds aren't really doing anything spectacular.
I
Right?
also
Bonds.
just think like the way the Fed's been playing this and being as conservative as possible, afraid of cutting too early, I just think the odds are they're going to remain paused. There isn't overwhelming reason for them to cut.
Yeah, there's not even the reason that you could lean on probably is that weak NFP report, which I'm assuming some Fed officials are leaning on that. You have Bissent basically saying if the Fed would have got the jobs report a week early or whatever it was back a month ago, right? They would have reacted on this. They would have cut already. Maybe that's true, but the fact that the Fed is spaced out the way that they are, they're going to get another. Well, what happens if the August NFP report, the NFP print is actually okay? What happens if the unemployment rate barely shifts between now and the next Fed meeting, right? You're going to have another unemployment report, and you're going to see the unemployment rate. Let's see. So where we are right now, we're at 4.2. If this has been pinned at 4.2, and my guess is a large part, this should be higher, but immigration's weighing on it, which is fine, okay. But the Fed has also acknowledged that labor is softening, but supply and demand are falling at a consistent pace, basically saying that the numbers are weaker, but the labor market's still in balance. Well, if that saying is still true, right? If that theory is intact even after the poor revisions, well, then the labor market is actually more in balance and the Fed has nothing to worry about. So, like you just said, the Fed being cautious is probably what I'm thinking to be a play here. And there's many ways to exit the trade. Maybe you have a Jackson Hole where Powell is almost semi-hawkish, just enough to the point where odds pull back, between now and Jackson Hole, where we go from 90 to 75. That already is an asymmetrical payout, right? Because, you have 10 points of risk here, right? Or 10% of risk, and you can price it all the way down to, if it trades midway, maybe you have a PCE report that moves the market down too, but that's more unlikely, but still possible. And therefore, you have a lot of time between now and the middle of September when the Fed's meeting to move the contracts either way. And I'm thinking, look, 50 basis points is probably way too aggressive. So there's more downside than upside risk, right? In the probability of a cut. So that's how we're looking at that now. And to hone this back again, irrelevant to our model in terms of RQF. If the Fed cuts at next meeting, yes, I believe it's a policy mistake, but it's not going to affect our positioning. So that's where I think we see the Fed here, and at least based on the verbiage we've been seeing from the Fed speak and based on the data laid out in the last SEP, it's hard to see the Fed get super dovish when nothing's really screaming. Nothing's really screaming help me. Yeah. If you guys want to access our models, feel free to visit our website at market-radar.com. You can get access to our daily reports and our macro base, which is free, and that has all of the macro data that we track of things like employment, inflation, and growth. Again, website's market-radar.com.